Ladies and gentlemen, good day and welcome to Larsen Toubro Limited Q1FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. P. Ramakrishnan. Thank you, and over to you, sir.
Thank you, Nirav. Good evening, ladies and gentlemen. A very warm welcome to all of you into the Q1FY23 earnings call of Larsen Toubro Limited. The earnings presentation was uploaded on the stock exchange and in our website around 6:40 p.m. IST. I hope you have had a chance to take a quick look at the numbers. As per past practice, instead of going through the entire presentation, I will take you through the key highlights for the quarter in the next 20 minutes or so, post which we will get into Q&A. Before I begin the overview, a brief disclaimer. The presentation which we have uploaded on the stock exchange and our website today, including the discussions during this call, contains or may contain certain forward-looking statements concerning L&T's business prospects and profitability, which are subject to several risks and uncertainties, and the actual results could materially differ from those in such forward-looking statements. During Q1 FY23, the Indian economy continued to exhibit resilience supported by relatively strong macroeconomic fundamentals and as evidenced by improving high-frequency economic indicators. Despite global turbulence and the rise in energy prices, both government and the Reserve Bank of India have succeeded in maintaining fiscal and monetary stability in the country. We can safely conclude that during this quarter, India remained a bright spot amidst continuing global chaos. Our group also reported a strong all-round performance in an otherwise seasonally weak quarter. Before I move further, I would like to mention that effective April 1, 2002, that is the start of this financial year, the operating segments of L&T have been reorganized in line with the business strategy to be adopted by the company under its 5-year Lakshya Plan 2026. We had articulated on this aspect when we spoke about the strategic plan roadmap for FY26 during the Q4 FY22 earnings call. Just to refresh, some of the existing segments have been realigned to reflect the group's Lakshya 2026 strategy. The changes are as follows. Energy projects. This is a newly formed segment that constitutes the current segments of hydrocarbon and power to reflect the company's integrated pursuit of opportunities in a rapidly transforming energy sector, including green energy EPC opportunities. The second segment is high-tech manufacturing, this being a segment that comprises the heavy engineering and the defense engineering business being combined to leverage the extensive engineering, manufacturing, and fabrication expertise across the various customer segments. IT and technology services. This segment, earlier comprising of the listed 3 ITTS subsidiaries, that is L&T Infotech, L&T Technology Services, and Mindtree, will now also include the new age businesses of data centers and e-commerce and digital platforms. Both data centers and e-commerce digital platforms are recently incubated businesses were shown under the other segment in the previous year. I will now cover the financial performance parameters for Q1 FY23. Our group order inflows for Q1 FY23 at rupees 418 billion registered a Y-on-Y growth of 57%. Within that, the projects and manufacturing businesses secured order inflows of rupees 281 billion for this Q1, registering a Y-on-Y growth of 85%. Our current year Q1 order inflows in the projects and manufacturing portfolio are mainly from infrastructure, hydrocarbon, and defense businesses. During the quarter, our share of international orders in the projects and manufacturing portfolio are at 33% vis-à-vis 15% in the Q1 of the previous year. The domestic ordering environment in Q1 was also significantly better compared to Q1 of the previous year. At a macro level, there was an improvement in domestic tendering and awarding activity. Secondly, we expect public capex spends comprising of centers, states, public sector units in the current year to be better than that of the previous year. Hopefully, the private capex would also witness improvement in the second half of the current year. Our order prospects pipeline for the remaining 9 months of the current fiscal is around 7.6 trillion rupees, comprising of domestic prospects of rupees 6.1 trillion and international prospects of rupees 1.5 trillion. The broad breakup of the overall prospect pipeline of rupees 7.6 trillion is as follows. Infrastructure segment, rupees 5.6 trillion. Energy, rupees 1.6 trillion. And projects and manufacturing, around 0.4 trillion. Finally, we remain confident of achieving the annual guidance we gave on order inflows at the beginning of this year. Moving on to order book. Our order book at rupees 3.63 trillion as on June 22 is once again at a record high. As our projects and manufacturing business is largely India-centric, 72% of this order book is domestic and the balance 28% is international. Of the international order book of roughly around 1 trillion, around 79% is from the Middle East and 11% from Africa. The remaining 10% is from various countries, including Southeast Asia. Clearly, the Middle East capex in infra and hydrocarbon is on an upswing post-recovery in the oil price. The breakdown of the domestic order book of rupees 2.63 trillion as of June is as follows. Central government 11%, state government 30%, public sector corporations or state-owned enterprise at 42% and private sector at 17%. Approximately around 26% of this total order book of rupees 3.63 trillion is funded by bilateral and multilateral funding institutions. As you can see from the slides, 91% of our total order book is from infrastructure and energy. Again, within infrastructure, our order book is well diversified across various businesses like heavy civil, water, power transmission and distribution, buildings and factories, transportation infrastructure, and minerals and metals. Finally, during the quarter, we have deleted around rupees 14 billion of non-moving orders from the order book. Our share of slow-moving orders in the order book is just around 3%. Coming to revenues, our group revenues for Q1FY23 at rupees 359 billion registered a Y-on-Y growth of 22%. International revenues constitute 37% of the revenues during the quarter. The IT and TS portfolio continued to report industry-leading growth in Q1 as well. In the projects and manufacturing business portfolio, our revenues for Q1 FY23 were at rupees 221 billion, thereby registering a Y-on-Y growth of 23%. The robust execution in infrastructure and power within the projects and manufacturing business portfolio during the quarter was to some extent offset by other businesses. I will cover the details a little later when I cover each of the segments. We remain confident on achieving the annual guidance on revenue given at the start of this year. Moving on to EBITDA margin, our group level EBITDA margin without other income for Q1FY23 is 11% vis-a-vis 10.8% in Q1FY22, up by 20 basis points. The detailed breakup of the EBITDA margin business-wise is given in the annexure to the analyst presentation. You would have noticed that the EBITDA margin in the projects and manufacturing business for Q1FY23 is at 8.2% vis-a-vis 8.8% in Q1FY22. This drop of 60 basis points for the quarter is explained by cost headwinds and the change in the job mix. Despite the recent correction in commodity prices, our average procurement cost for the quarter was still higher compared to the corresponding quarter of the previous year. We retain our annual guidance on EBITDA margin in our projects and manufacturing portfolio at 9.5%. The recent commodity price correction brings in the much needed relief, but since our EBITDA guidance for the current year was constructed basis the average price levels of FY22 assumed, we believe it is prudent to retain the margin guidance for the year at the same level at this juncture. We will have better visibility on improvements, if any, as the year progresses. Our operational and reported PAT for the quarter at rupees 17 billion registers a healthy growth of 45% over previous year Q1, largely aided by the improved group level EBITDA margin as well as improved treasury operations and a lower tax expense. The group performance P&L construct along with the reasons for the major variances and the respective function heads is provided in the analyst presentation. Coming to working capital, our NWC to sales ratio has improved from 22.9% in the quarter one of the previous year to 20.9% in the current quarter. However, this ratio has moved up from 19.9% that we reported for last year as a whole. NWC to sales moved higher on a sequential basis primarily due to vendor payments which fell during the quarter. As we have stated before, Q1 of every financial year is seasonally a weak quarter for customer collections. Having said that, let me mention here that our customer collections for Q1 FY23 is substantially higher than that the corresponding quarter of the previous financial year. Our group level collections, excluding financial services for Q1 FY23 is around 0.34 trillion rupees vis-a-vis rupees 0.27 trillion in Q1 FY22. Although we expect some interim volatility in the NWC to sales ratio for one or two quarters, we will endeavor to bring down our NWC to sales ratio closer to 20% by March 23. Just to reiterate here, we had guided for NWC to sales ratio of ranging between 20 to 22% for FY23. Moving on to the balance sheet, if you glance through the balance sheet given in the annexures to the analyst presentation, you would notice that at the group level, the group debt equity ratio has improved over March 22. We are at the same net debt equity ratio in June 22 vis-a-vis March 22. This is mainly due to repayment of liabilities of the financial services business around 36 billion rupees and development projects rupees 19 billion offset by rupees 23 billion increase in the parent. Some portion of our debt in the parent company is coming up for repayment and therefore this incremental borrowing at parent is largely front-ended in an environment of rising interest rates. Finally, our trailing 12-month ROE for Q1 FY23 is 11.5% vis-a-vis 17.2% in Q1 FY22. As you are aware, the trailing 12-month ROE for Q1 FY22 includes the benefit of the one-time gain on the divestiture of our electrical automation business, net of exceptional items. However, on a sequential basis, our ROE has improved from 11% in March 22 to 11.5% in June 22, an improvement of around 50 basis points. A robust business portfolio, focus on working capital management, improved working capital management, and focus on cash generation stroke distribution, and finally the divestment of core assets will lead to better ROEs as envisaged in L&T strat plan for FY26. Very briefly, I will now comment on the performance of each business segment before we give our final comments on our outlook for the near term. Infrastructure segment. On order inflows, our Q1 FY23 order inflows are well spread across various sub-segments. Infrastructure segment secured orders of rupees 183 billion for Q1, registering a healthy growth of 66% over Q1 of the previous year. During the quarter, orders well diversified across public spaces, metros, waste management and wastewater, minerals and metals, factories, data centers, and power transmission and distribution. Our order prospect pipeline in infra for the remaining 9 months of the current financial year is around rupees 5.61 trillion, comprising of domestic prospects of rupees 4.76 trillion and international prospects of rupees 0.85 trillion. The subsegment breakup of the total order prospects in infra is as follows. Power transmission and distribution would be around 19%, water 22%, transportation infrastructure 19%, heavy civil 18%, buildings and factories 20%, and minerals and metals for the balance. The order book in this segment at rupees 2.64 trillion as on June 22. The book bill for infrastructure segment is around 36 months. The Q1 revenues at rupees 142 billion registered a growth of 36% over the comparable quarter of the previous year, aided by improved execution momentum as the COVID-related challenges receded in the current quarter. Our EBITDA margin in this segment dropped from 7.1 in Q1 FY22 to 6.5% in Q1 FY23, largely impacted by input cost escalation and changes in the revenue mix. Moving on to the next segment, which is energy projects. The receipt of a large order from the Middle East in the offshore vertical of hydrocarbon business buoys the order book of this segment, whereas subdued ordering environment continues in the thermal power business. The order prospects pipeline of rupees 1.6 trillion for the balance 9 months is healthy. The order book for this energy segment stands at rupees 654 billion as on June 22, with the international order book constituting 58% share. The Q1 FY23 revenues at rupees 50.7 billion registers a growth of 3% over the comparable quarter of the previous year, that is largely attributed by healthy execution in the power business on the back of a robust opening order book. The hydrocarbon revenues, on the other hand, were impacted to some extent due to client delays and supply chain issues. The EBITDA margin for this segment at 8.5% for Q1 FY23 improved compared to 7.5% over the corresponding quarter of the previous financial year. The execution cost savings aided hydrocarbon margins, where cost contingency release improves the power margin. We will now move on to the high-tech manufacturing segment that comprises the heavy engineering and the defense engineering businesses. In Q1 FY23, this segment witnessed a broad-based pickup in order inflows across defense and heavy engineering businesses. We have an order prospect pipeline of rupees 300 billion in the remaining 3 quarters of the current financial year. The order book of this segment is at rupees 194 billion as of June 30th, 2022. The revenues for Q1 FY23 at rupees 12.7 billion registers a marginal growth of 3%. Improved execution drove heavy engineering revenue, whereas tapering of certain shipbuilding jobs in the defense engineering business impacted defense revenues. The EBITDA margins in this segment is at 15.1% in Q1 FY23 vis-a-vis 19.2% in Q1 FY22. The previous year margin in this segment was higher, primarily due to release of cost provisions on the completion of a key project and also due to recognition of certain customer claims. As we repeat in every quarter, let me once again mention that the defense engineering business does not manufacture any explosives nor ammunitions of any kind, including controversial weapons. The business also does not customize any delivery systems for such munitions. Coming on to the IT and TS portfolio, our revenues for Q1 FY23 at rupees 94.2 billion registered a growth of 30% over the corresponding quarter of the previous year, reflecting the continuing growth momentum in this sector with a surge in demand for technology-focused offerings. The business outlook for the segment continues to be good. A lot of spends today are being directed towards cloud, data center security, machine learning and artificial intelligence. The margins for this segment is a function of wage costs offset by operational efficiency. The merger between LTI and Mindtree is progressing satisfactorily and should hopefully be concluded by the end of this financial year once all the regulatory approvals are obtained. I will not dwell too much on this segment as the fact sheets of all the 3 companies are already available in the public domain. We now move on to financial services segment. Here again, L&T Finance Holdings is a listed subsidiary and the detailed results are available in public domain. L&T Finance thrust towards retailization continues, and as of June 22, the share of retail in the overall book has moved up to 54%. The strategic deliverables in this business revolve around portfolio reorganization, strong asset quality, and improvement in return on assets. This business endeavors to be a top-class, digitally enabled retail finance company, moving from product focus to a customer focus approach. Finally, to conclude, sufficient growth capital is available in the balance sheet. Moving on to development project segment. This segment currently includes the power development business that comprises of Nabha Power, and last quarter on the Q1 of the previous year also included Uttaranchal Hydropower that was divested in August 30th, 2021. Besides Nabha Power, the segment also includes Hyderabad Metro. As you may be aware, the roads and transmission line concessions, which are forming part of L&T IDPL, are consolidated at a PAT level under the equity method. The majority of revenues in this segment is contributed by Nabha Power. Improved ridership with Metro and a 95% average PLF in Nabha drive revenue growth for this segment. Just to give you on some statistics, the average Hyderabad Metro ridership improved from 55,000 passengers a day in Q1 FY22 to around 285,000 passengers per day in Q1 FY23. Our average ridership in the preceding quarter, that is Q4 FY22, was 199,000 passengers per day. We are happy to report that as we speak, the current ridership in Metro has touched also a peak of 377,000 passengers on one of the days this month. The Q1 FY23 margin in this segment at 4.5% is contributed by metro operations only, as NABA margin is not being recognized from Q3 of FY 2021. The improvement in average daily ridership has enabled Metro to report positive EBITDA for Q1 FY23 vis-a-vis an EBITDA loss for Q1 FY22. The Metro, at a PAT level, we consolidated loss of rupees 3.25 billion rupees in Q1 FY23 vis-a-vis a loss of rupees 4.72 billion in Q1 FY22. The operating and amortization costs are around rupees 0.75 billion, whereas interest cost is rupees 3 billion for the quarter. At this juncture, I would like to give you a quick status update on the divestments of our concessions portfolio. As all of you are aware, our stake in hydropower plant, that is the Uttaranchal hydropower project, was successfully divested in Q2 FY22. For NABA, various divestment options are being explored currently. Coming to IDPL, we are also exploring the possibility of divesting our remaining 51% stake in favor of third-party investors. For Metro, with the prospect of improved ridership and the confirmed government assistance, including a phased TOD monetization, and with the recently concluded debt refinancing, the performance parameters for Metro should definitely look up in FY23. We are also discussing with strategic investors for equity infusion into the SPV. However, it is premature to comment on timelines at this juncture. Moving on to the last segment, Others segment. This segment comprises realty, industrial machinery, industrial valves, and smart world and communications businesses. During the quarter, the strong revenue growth in realty due to the higher number of handing over of flats and the industrial machinery business was offset by subdued revenues in valves and smart world and communications. Despite this, the revenues for the segment at rupees 16 billion registered a growth of 21% over the corresponding quarter of the previous financial year. The EBITDA margins for this segment at 17.2% for Q1 FY23 remained stable compared to 17.1% during the corresponding quarter of the previous year. Coming to the last part of my presentation, we remain optimistic on India recovery despite the ongoing global geopolitical uncertainty. The government's persistent efforts to jumpstart economic growth through higher infrastructure spend and incentivizing domestic manufacturing should yield benefits in the medium term. Possibly the private capex should also join this bandwagon in a couple of quarters. On the global front, amidst the continuing chaos, we are closely monitoring the movement of commodity prices and resultant supply chain disruptions. Surprisingly, the Middle East has a better budget visibility due to the high energy prices and continues to spend on hydrocarbon and infrastructure projects. This augurs well for the company in terms of providing a larger scope of contracting opportunities. For the year FY23, we retain our guidance of 12 to 15% growth in the group order inflow and revenue, and our margin in our projects and manufacturing business portfolio to remain around 9.5%. On the working capital side, the group level NWC to sales, we have given a guidance for a range of 20 to 22%. We will continue to endeavor to end March 23 at around 20%. The company in its first year post announcing its Lakshya 26 strategic plan expects to continue its planned trajectory of profitable growth through efficient and timely execution of its large order book, and along with its many value-enhancing measures, to retain its leadership position and improve shareholder on a sustainable basis. The company is on the path of diversification into new businesses of green energy and e-commerce and digital platforms, and at the same time pursuing exit options, or limiting exposure in non-core businesses over this Lakshya 2026 strategic plan period. Thank you, ladies and gentlemen, for the patient hearing. We will now take the Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Mohit Kumar from DAM Capital Advisors. Please go ahead.
Sir, congratulations on a very, very good quarter, especially on the order inflow. Sir, does your confidence level on the order prospects have improved compared to the end of Q4? It seems there has been increase in prospects because I think the prospect come down from 8.5 to 7.6, while the last quarter order inflow was around 40,000 crore. And which are the segments where the prospects are improved?
So thank you, Mohit. In fact, at the start of the year, we had given the order prospects at around 8.6 trillion rupees, and today it is at 7.66. Even at the start of the year, we were very careful in targeting the opportunities that will come up, and we are pursuing a very selective basis of bidding. And basis the kind of awards that has been tenders that were opened during the quarter and the awards that got finalized and the share of L&T's awards, we do believe that we have against the current order prospects of rupees 7.66 trillion, considering the award win ratio that we expect to happen, we are reasonably confident to meet the order inflow guidance of 12 to 15% that we have given. Essentially, the orders that we expect to happen in the next 9 months or so will once again be a share of infrastructure will continue to have a lion's share, and followed by hydrocarbon opportunities. And as I mentioned just now, that the hydrocarbon opportunities in the Middle East has also picked up, and we do believe that we have a fair share of getting order wins in both infrastructure and hydrocarbons. Basis the, I would say, very positive ordering environment that we see in India and Middle East in the next 9 months or so.
Understood. So on the private capex, the first time we are seeing a very, very positive commentary compared to last 2 quarters. How confident are you of private capex to pick up, especially in 12 to 24 month horizon?
Okay, in sense of L&T scope in the private sector capex, I would say would be largely focused on the minerals and metals, and also to some extent in the buildings and factory space. As is already available in the public domain, the steel sector and including the other non-ferrous metal producers are looking forward to expansions of their existing production lines, including putting in additional complementary equipment in their existing plants. Most of the metal majors in this country are long-standing L&T clients, and we do expect that the announcements that they have been making should fructify into reasonably good ordering opportunities, at least in the later part of the current financial year. Similarly, on the infrastructure side, we see a reasonable uptick of opportunities in the IT real estate space. Many of the IT companies, given the fact of given a hybrid kind of a working environment, they are also looking forward to put in more number of campuses, if not in size, but more in terms of campuses across the country, as they tap talent to work from a sort of a work from anywhere kind of a situation. So we do expect some amount of capex opportunity to come for us. Besides this, the country is also witnessing a lot of investments in data centers, and there again, L&T does have belief that some of these data center ordering that will happen, L&T stands to get a good share. Lastly, the e-commerce businesses are also set to expand their delivery capabilities, and that requires more amount of logistics and warehousing spaces, and we do expect a strong momentum of ordering opportunities in this segment also.
So lastly, sir, are you bidding for coal-based projects, or is it a completely no-go for us?
Unlike the last quarter, when we went with the Q4FY22 call, the amount of coal-based opportunities that we witnessed was not as much as what we see today. We do believe that some of the major thermal power producers are thinking of putting up newer plants almost in the nature of 6,000, 7,000 megawatts. But there is a good amount of competition, and we will be selective in the bidding in this particular segment. But definitely we see an uptick of opportunities coming up for coal-based power plants in the near term.
Understood, sir. Thank you and all the best, sir. Thank you.
Thank you, Mohit.
Thank you. The next question is from the line of Ashish Shah from Centrum Broking Limited. Please go ahead.
Yeah, good evening, Pierre. Hi.
Good evening.
My first question is on the Hyderabad Metro. So could you update on what is the status of the support that we are expecting from the Telangana government? Where are we in that process? And secondly, in the cash flow, one sees 910 crore of long-term investment being made in the first quarter. So would that be to support Hyderabad Metro, or is some other asset where we invested?
Okay, so the first point of your question, Ashish, is that with respect to the Hyderabad Metro, the Metro SPV company has executed the supplementary agreement with Hyderabad Metro Rail Corporation, which is the grantor of the concession. And we are looking at getting a funding assistance of almost 3,000 odd crores in the next 2 years in the form of long-term interest-free loans. We also have the approval of the grantor to monetize the TOD rights that the L&T Metro Rail Corporation has. In terms of the approval contains in terms of delinking our ability to TOD monetize irrespective of whether the metro operations continues with L&T or not. So to that extent, it's a very favorable development. We have been talking of this in the past as well, but I would like to tell you that in the current month, we have executed the supplementary agreement, and that is going to hopefully, as I stated earlier in this call, the improved ridership, the government assistance, the TOD monetization, and the possibility of a new investor, if we are able to tie it up, obviously the impact of Hyderabad Metro on L&T's financials should hopefully come down. Secondly, to the question of the long-term, the other question that you talked about, that is essentially L&T Finance security receipts by converting some part of their loan book into ARC.
Okay. So what was the support that we would have given for Hyderabad Metro this quarter or nothing? This quarter.
The financial support that we gave in the current quarter is almost around 230 odd crores. And the exposure of L&T to Hyderabad Metro as of June is around 7,400 crore.
Just one more bookkeeping. The tax rate for the quarter is low. So what is driving that low tax rate? And in general, what should we expect for FY23? Because it's kind of becoming very difficult to predict that, plug in that tax rate. If you can help us, it will be good, sir.
Okay, so in this quarter, as you may be aware, Mindtree has shifted from the old tax regime to the 25.19 new tax regime in the current quarter. When L&T, and this is a CFS adjustment, that is a consolidated financial adjustment, pursuant to Mindtree shifting to the new tax regime at a lower rate, the deferred tax liability that we had accrued at the older rate at the consolidation level has also taken an appropriate entry. And to that extent, the tax provisions, I would say, has been by way of a credit in the DTL of almost 134 crore rupees. To that extent, I would say it's one type of an event, one-off event in the current quarter. This should not happen again. So basis that you can see in the next 9 months, the normalized tax rate should apply across the group.
Sure. Would that be like closer to 30% on a consolidated basis?
It would be around 25 to 27%.
25. Sure. Thank you. I'll come back if I have more. Thank you.
Thank you. Next question is from the line of Ankur Sharma from HDFC Life Insurance. Please go ahead.
Yeah. Hi, good evening. Thanks for your time. I have 3 questions. One, little surprised to see the slowdown in execution on the hydrocarbon business, given the fact that, we had a very strong order booking and order book as of end of FY22. So while you did highlight some supply chain issues and some client delays, if you could help us understand, is this more of a, just a Q1 phenomena, kind of picks up as we go through the coming quarters?
So Ankur, let me tell you that this is a Q1 specific issue, that there were certain client delays in terms of approvals and there was some supply chain issues. It doesn't mean that the execution momentum will not get into higher level. This is specific to Q1. We don't expect that to happen in the balance 9 months.
Okay, fair. Secondly, sir, on the infra margins, right? Now, of course, the backdrop is that, RM prices have corrected meaningfully, across steel, pretty much all metals. So fair to assume that at least, as we go into the coming quarters, at least on a YOY basis, we start seeing margins on the infra segment look higher. Would that be a fair assumption? Not wanting an exact number here, but at least on a YOY basis, it's fair to assume that infra margins look better from Q2 onwards on a YOY basis. Yeah.
Okay. So in Q1 FY23, the infra margins was at 6.5% as compared to 7.1% in the previous year. Now, instead of talking specific to infra margins, if I take at the projects and manufacturing portfolio, given the fact that it's an EPC contracting company, quarter on quarter developments on the execution side, the amount of projects that get into valuation threshold, the closure of projects, the release of cost provisions towards closure, all of that is a sense of a dynamic situation. Mm-hmm. However, in Q1, the impact of the drop is largely because of commodity prices, because these procurements, what we have put on the site during Q1 are essentially against orders that would have been placed in the previous quarter at elevated commodity prices. But going forward, whatever procurements that will happen, that will get into the activity level and thereafter revenue recognition, hopefully I think it should be at a lower level. But as I said during the earlier part of my call, that while we gave a guidance on the entire projects and manufacturing portfolio at 9.5%, we also stated that the cost of commodity prices that we have taken for FY23 is an average of FY22. And what we see today is essentially most of the prices are coming to what we call an FY22 average levels. So this in a way has been factored in our yearly guidance that we have provided at 9.5.
Okay, fair. And lastly, so just on the domestic ordering, and it's nice to, know the pipeline, which I think now you share every quarter, so that's extremely helpful. But just going into the domestic part a little more, in terms of the end segments within the domestic infra piece, which segments look the most promising? State ordering obviously has been quite weak over the last year or so, which is reflected in weak orders in water, in some way, other segments as well. So just if you could help us, sitting here today, which are the segments you're most positive? We've also heard about some tendering pickup on the bullet train side for Maharashtra section as well. So some color there would be appreciated. Yeah, thanks. That's all.
Okay. So, Ankur, the total order prospects pipeline for the balance 9 months that I mentioned at rupees 7.6 trillion. Against that, rupees 6.14 trillion is domestic opportunities. Okay? If I give you a slightly granular details, in terms of infrastructure segment, that comes to around 4.76 trillion against that 6.14 trillion rupees. That's the order prospects we have for domestic infrastructure. And there, where we see in terms of the order prospects which are likely to come into ordering momentum, in the buildings and factories subsegment, we do see a lot of ordering opportunities across public spaces and health. When I say refer to public spaces, I am referring to central secretarial, state secretarial buildings. I am referring to railway station, new railway station developments. And on the health, it is a lot of money is being spent at the various state level on setting up of hospitals. So this itself is a significant chunk, I would say, in the B&F portion, that is buildings and factories. In the heavy civil portion of the prospects, we do feel a lot of opportunities or prospects in terms of hydels and tunnels and metro. This itself is a large piece of action that we expect to happen. The water segment also has a lot of opportunities in rural water supply and irrigation projects. Again, a major part of the entire prospect of opportunities in the water segment. Power transmission distribution, more on the transmission distribution of almost 70% of the opportunities coming there in the segment. The balance 30% is renewables. That's the overall, I would say, on the infrastructure piece in terms of where do we see opportunities, public spaces, health, hydel projects and tunnels, metro, rural water supply, irrigation, and the entire scheme of renewables and power transmission distribution. Coming to the hydrocarbons piece, the total prospects pipeline in domestic is around 0.39 trillion rupees, largely comprising of onshore, I would say onshore means not offshore, onshore and construction related prospects of majorly comprising of this 0.39. On the power, as I mentioned, I responded to an earlier question, the power opportunities in India is almost 0.58 trillion, largely led by coal, which is around 0.49 trillion rupees. So, and coming to defense, we do have almost 0.25 trillion rupees of order prospects that we are looking at in the next 9 months or so.
Great. Got that. Thanks and all the best. Very helpful.
Thank you. The next question is from the line of Sujit Jain from ASK Investment Managers. Please go ahead.
Yeah, thank you. Sir, if you can quickly spell out the balance sheet for Hyderabad Metro, as in equity, the debt, cash support from L&T, and accumulated losses.
So the total balance sheet would be in the range of 19,000 crores. Okay. Just 1 second. I need to get into. Okay. So if I say the total balance sheet of around 20,000 crores, out of which L&T equity is 2,400 odd crores, then there is a total, I would say, external borrowings of around 13,000 crores. And the balance, as I said, L&T's exposure to Hyderabad Metro is around 7,400 minus 2,400 equity. So that comprises the additional funding assistance. External borrowings are 13,000. So 13,000 external borrowings plus L&T exposure at 7,000, that sums up at 20,000 crores.
And the current accumulated losses as they stand?
Would be around 4,000 crores.
And just to quickly understand the sales, the OPEX, depreciation, interest and tax for the quarter.
I have already told that that it is around 0.75 billion rupees for the quarter and 300 crores as interest.
If you can just spell out the depreciation so that we can back calculate the cash loss.
75 crores per quarter.
Sure. And what will be the capital employed that will get released from the three assets, that is L&T IDPL 51% stake, Nabha Power, Hyderabad Metro, you already told. If these were to get sold, what is the capital employed that is currently sitting on the consolidated balance sheet?
As I mentioned earlier, that we are looking forward to limit our exposure in the concessions. We are looking to divest in IDPL and also Nabha Power. So it is all work in progress. So in terms of our exposure to IDPL would be around in the nature of 1100 crores and Nabha exposure 2400 crores. That's the current carrying value that we have. But question of time as to when we will release and how much we will release.
Sure. And just one last question on slide 26. That is your cash flow statement. Net sale and purchase of current investment that has released 28 billion rupees for Q1 FY23. If you can just explain that.
That's a reduction of our, I would say, overall surplus that we have at the group level. Cash surplus.
Oh, okay. Sure, sir. And the long-term investment sale 9.1 was on the account of?
ARC.
As I said earlier, that there has been the sale of a portfolio of L&T Finance to ARC, security receipts of almost 645 crores.
Right. Thank you so much.
Thank you. Next question is from the line of Renu Baid from IIFL Securities. Please go ahead.
Yeah, good evening, sir, and thanks for the opportunity. Two questions from my side. First, if you can help us understand that though there seem to be one or two orders which were debooked this quarter, can you elaborate which segments or which orders were they related to? Domestic, international, and which business segment?
So in terms of the international orders, we had secured one order in the hydrocarbon space, one large order. And in the other part, we had secured one reasonably large order on the defense engineering space also. And similarly, we have secured one order in the Middle East with respect to power transmission and distribution. All of this would be aggregate to around 10,000 crores or so.
Okay. And which segments were the orders which were cancelled during the quarter or which were debooked related to?
That's a small amount. Essentially, was smaller orders, some amount of smaller orders aggregating to 1,400 crores, essentially in power transmission, distribution, and transportation infrastructure.
Okay, so nothing material there.
Yeah.
Secondly, on the infra margins, though we understand that it was more of a transient impact of commodity cost, but if you see fourth quarter also, there was an impact of commodities because of which we missed on the infra margin front marginally. And at the onset of this year itself, infra margins have been sub 5%. So broadly, while the guidance is for the entire segment and not just sub-segment infra which is there today, but do you think that infra margins in itself as a sub-segment should be back to 8-9% levels once these commodity pressures ease out and the mix of projects which are under execution start?
So, infra margins last year was around 8.2%, Renu. Okay, but as a guidance, you will know that L&T, we give guidance at the overall P&M segment for obviously the reasons because each of these sub-segments are essentially an aggregate of pursuing EPC opportunities across multiple segments. So in some segments, you could have a mix of jobs that have get into margin recognition. Some segments are having some orders are getting into closure where we will be able to get some margin releases if the margins have been higher than what we bid for. But when we gave the construct of 9.5 is an overall construct at the overall portfolio level of projects and manufacturing. Basis the assumption that commodity prices in FY23 will be an average of what FY22 was. Q1 did not witness that because obviously the costs that have been booked is basis the elevated commodity prices that was there prevailing the last 6 months or so. But now that with the recent, I would say, softness in the commodity prices, hopefully the procurement costs also should come down and hopefully result into, I would say, better margins in each of the segment. And having said this, at this juncture, we would still like to maintain at 9.5. We are working to improving margins through, better or more higher improved execution of projects, and also possibly if some of the customer claims that we had factored in last financial year did not materialize, if they could materialize, should hopefully improve the margin trajectory from whatever we have given guidance.
Sure. And just to clarify, the margin guidance probably will not assume much of, as in the bullet train project margin recognition of bullet trains, since this would be the first proper full year of execution, we may not be able to cross that threshold limit this fiscal.
The C4 and C6 packages of the orders have actually crossed the threshold margin in the Q4 of the previous year. So yes, the momentum of execution will be the maximum in the current year and possibly in the next year as well.
Okay. And lastly, what percentage of the backlog that we have today is on fixed price basis?
It's still around the same level, Renu, that at the overall projects and manufacturing portfolio, we would have 1/3 of the contracts at fixed price. The balance 2/3, I would say, variable price in terms of actual reimbursements or linked to indexes.
Got it. Thanks much, sir, and all the best. Thank you.
Thank you.
Thank you. Next question is from the line of Aditya from Investec. Please go ahead.
Hi, good evening, sir. So
Good evening.
Certain Middle East media articles have indicated that L&T has been the lowest bidder in a fairly large hydrocarbon renewables facilities contract for NEOM. Anything that you can speak about on that contract?
At this juncture, I think we will not be in a position to comment on client names or the sectors, so kindly excuse me for that.
Sure, but are we pursuing renewable and hydrogen opportunities actively in the Middle East?
Like the way we are pursuing our competencies for opportunities in India, the same stress and emphasis goes on to Middle East as well.
Understood, sir. And so just wanted to clarify, roughly similar time last year, our order pipeline would have been somewhere around 8.9 to 9 trillion rupees. So to that extent,
8.6 trillion rupees was the order pipeline.
Understood. So in overall pipeline terms, we may be slightly lower, as was the case at the beginning of the year, but we are possibly
same. Like the way we started last year with a 9.06 pipeline, but this time we started the year at around 8.56 trillion. So this time we have been a little, I would say, selective in pursuing the bids and the ordering opportunities. So we do believe with a better run rate on awards happening and we getting a fair share, we are reasonably confident to get into the guidance of 12 to 15% that we have provided for order inflows.
Understood, sir. That helps. Thanks.
Thank you. The next question is from the line of Kunal Sheth from B&K Securities. Please go ahead.
Yeah, hi. Thank you for the opportunity, sir. I just wanted to hear your thoughts on how has been the execution environment, has it, especially both on domestic and overseas side, has it improved, and are we seeing any major constraint, or now more or less, most of the issues are behind us and we will see, much, easier execution going ahead?
So Kunal, I will restrict myself to Q1. Q1 was just like any other normalized quarter for L&T prior to the onset of COVID in terms of workforce ability, in terms of overall, I would say, supply chain as well. However, as is normal in any normalized quarter pre-COVID, you can have certain things like the way I talked about hydrocarbons. There was right of way, some issues, client delays on approvals, and even some supply chain disruptions. I won't say supply chain disruptions, supply chain delays. So I would put it like this. It seems to be a normalized 9 months as well. But you never know, because with COVID gone, now we are talking of something else like monkeypox and so on. So I would say, as it stands now, it's a normalized, I would say, execution environment. The only one point I would like to emphasize is that L&T for the last 2.5 years or so, we have been focusing to execution ramp up is a direct function of payments from clients happening on time. So if we find that any particular project, the periodicity of payments is getting delayed, or there has been substantial delay in payments, in such cases, we are consciously ramping down, we are bringing down the execution in such of those sites. But otherwise, from an environmental perspective, as it stands now, it is normal.
Oh, sure, sir. That was my only question. Thank you so much, and best of luck for the future quarters.
Thank you.
Thank you. The next question is from the line of Deepak Mundra from JP Morgan. Please go ahead.
Hi, PR. Deepika here. Hello, can you hear me?
Yes, please. Yes, Deepika.
Okay.
I can hear you.
Okay, great. PR, I mainly wanted to understand how the commodity price, the recent fluctuation is impacting order inflows, as well as execution. Are you seeing better traction on, the prospect materializing because of a shift in the commodity prices?
See, Deepika, I have to provide you a statistic here, because I think that statistic itself will communicate in a way that the ordering momentum as far as India and Middle East is concerned, which are the two primary geographies for our projects and manufacturing portfolio, seems to be quite robust. The tendering activity in terms of the tenders that got announced in Q1FY23 was almost rupees 2566 billion. Okay, 2.5 trillion rupees, as compared to 1.35 trillion rupees of Q1 FY22, which is almost an increase of 90%. And obviously the tenders that have been opened out in the current quarter at that 2.56 trillion obviously takes into account that the clients are aware of the increase in the commodity prices. And the award to tender ratio, a more important metric, is for Q1 FY23, the award to tender ratio stands at 70% as compared to Q1 FY22 at 39%. So we believe this itself in a way communicates that yes, commodity prices have gone up, project costs have gone up, but I guess the kind of the India growth trajectory that we believe is going to be fairly positive. The government tax collections also has been quite, I think, higher than what was expected. The government has, it seems, has collected 7 lakh crores of total in aggregate of taxes in Q1, which is far ahead of the estimates, far ahead of almost a 25% increase of Q1 of the previous year. So with improved tax collections, we believe that the ordering momentum will continue, largely led by the government. Of course, there can be black swan events, but at this juncture looks to be fairly good for India, and we do believe that India continues to be a good spot for investment-led economic growth momentum.
Okay. And secondly, on the fixed versus variable priced orders, I think last year there were far more variable priced orders which were being booked. On a flow basis, is that changing now with the decline in steel prices?
No, actually speaking, I think last year also in terms of structurally, it has been 2/3 variable and 1/3 fixed. Okay. So most of the infrastructure orders are largely orders where we get pass-through mechanism in some form or the other. Whereas in the case of hydrocarbons, typically some of those projects are usually fixed price contracts. Now, if the momentum of ordering in hydrocarbon segment goes up as compared to infrastructure, then the percentage of the fixed price contract should be inching up higher. But otherwise, if it continues the way it has been for the last 2 years, I guess this 66-33% kind of a breakup will continue.
Understood. And last one, could you comment anything on the competitive intensity in Middle East, given that you're seeing so many large, tenders coming through?
The opportunities, especially in the hydrocarbon segment, Deepika, I think is quite robust, and I believe that with L&T's capability and its scope of offerings, we do have a good chance of winning some of the packages. And there is, I would say, at this juncture, a place for all.
Understood. Thank you so much and all the best for the year.
Thank you.
Thank you. Next question is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thank you so much, and congrats on good numbers. I think last time there was some commentary from your side that because of sudden change in commodity prices, some of the tenders seem to have been delayed. Government officials have gone back to recalibrate. That seems to have sorted out now, is it?
So Puneet, in fact, in the second half of the last year, the kind of, I would say, the tenders did get delayed. Okay. We did not see tenders being announced in the same robustness that we saw in the previous year 2 quarters. But the way the first quarter has started, as I just now responded to Deepika's question, I think the tendering momentum has regained pace, and hopefully I think should continue to remain at elevated levels in the next 9 months as well.
Excellent. And in terms of the commodity price correction, should we see some benefit coming in Q2 itself, or you think it goes with a lag of a quarter or so?
I think, Puneet, this is the 4th time the question on margins is coming. I have already explained that as we speak, given our order book and given the kind of execution plan that we have across all the segments, we are fairly confident that we should be able to touch that 9.5% as we close the year. You can have quarter-on-quarter volatilities, but that's the intrinsic part of whomsoever is following L&T business. Typically, the second half of the year is a very busy second half as compared to the first 6 months. And we have started Q1, I would say, quite favorably.
Understood. And lastly, on some of the new initiatives that you announced last time, any capital allocation so far in 1Q or too early?
It's still too early in terms of if I say to put it across the investment cumulative that we have made on data centers and both the e-commerce and the digital platform, all aggregate around 200 odd crores. But no major investment has yet to happen on the green energy side. Because as we said earlier, the first priority is to tie up with a technology partner and then set up the JV.
So the line for the participant dropped. We move on to the next question.
Okay.
The next question is from the line of Sumit Kishore from Axis Capital. Please go ahead.
Hi, good evening, PR. My compliments on a good set of numbers.
Thank you, Sumit.
Yeah, my first question is, it appears that the domestic order prospects have got a boost in relative terms versus overseas, because domestic order prospects have come off from 6.31 trillion at the beginning of FY23 to about 6.1 trillion now. So is there any specific sub-segment in domestic which has been faring better in terms of new prospects?
Okay, so Sumit, in June 21, I think the total order prospects that we had provided was 8.96 trillion, out of which the share was domestic was 70%. Okay?
Right.
And today as we speak, the share of domestic order prospects to the total order prospects is 80% at 6.14 trillion. Okay?
Right.
So the share of infra was earlier at 5.05, is marginally down to 4.76. Hydrocarbons was previous June 21 was 0.52, it's now at 0.4. Power is also at 0.48 to 0.58. I don't think there is any structural change in terms of saying that a particular segment is showing higher prospects. I think it's more to do with the fact that we have been a little more selective this time as compared to the last year into targeting opportunities where we believe that these are large enough where L&T will bid and have a good chance to win.
Sure. So being selective essentially means that you expect a better win ratio as well because you have been selective.
Time will tell.
You put out a press release that L&T has signed up 3 projects worth $1 billion in prime locations in MMR, about 4.4 million square feet with a 80 billion rupee development opportunity. So does that essentially mean that, it's like a harbinger of a contract for L&T for construction in buildings and factories, which has already been booked, or
So, Sumit, obviously, yes, we have executed what we call in that industry parlance binding agreements to jointly develop at certain plots across Mumbai. But in terms of transitioning all of that into a business opportunity for both reality and potentially the construction arm of our infrastructure segment, I guess it's still some time away, because we may have executed binding agreements to develop it, but there are a lot of, as you know, there are a lot of steps before we actually get into development in terms of approvals and all other stuff. So we have joint development agreements, binding agreements for properties across South Mumbai, Andheri and Thane. But I believe that it will still take some time before we receive all the clearances before we launch these projects.
okay. So it may not be prudent for us to consider that as an order in Q2.
Q2? Current year? No. I think it's still time off. We will articulate that at an appropriate time.
Yeah. Just one quick question on the fact that, like, an instance of big water sewage treatment contracts awarded by BMC, almost 260 billion rupees in Bombay, broken up into 6-7 packages. L&T got one package simply because you couldn't take more than one. The Jewar Airport went to Tata Projects. So I know these are, but in airports, L&T had a sort of dominance for PPP, EPC, among the big greenfield airports. What are your thoughts? Is the competitive intensity for big ticket contracts of 20 billion plus going up simply because bigger packages are being broken up into these smaller ones, which are still 20 billion plus, and the breadth of players who can take 20 billion plus contracts, is that going up?
So, Sumit, it is like this, that competitive intensity we do see, as has always been in the recent past, very intense in some segments, and some segments we do see a reduced competitive intensity. But wherever there is competitive intensity is low, does not necessarily mean that L&T should get. But one thing I would like to tell, that wherever we are quoting for jobs, we are very careful about our ability to ensure that we don't compromise on our margins. And that is I would say, the fundamental pillar, taking into account, like in the case of airports, I believe we almost have a 90% share of all the contracting opportunities that have come. And we have learnt to bid and execute such contracts with some more of experience. So we are very careful in terms of pricing, and obviously in many projects you can have L&T winning some and probably L&T losing some.
Fair enough. Thank you so much for answering my questions. Wish you all the best.
Thank you.
Thank you. Next question is from the line of Parikshit Kandapal from HDFC Securities. Please go ahead.
Hi, PR. Congratulations on a great quarter. So my first question is on the tendering. You see the tendering is up 90%, and the award to tender ratio is up from 39 to 70%. But our order book has only grown 57%. So have we lost some market share here?
No, I won't agree to that particular conclusion, that, whatever, order prospects that we had at the start of the year, against that, I would say that we have got reasonably a good share. So almost 88,000 crores of that orders that we bid for, we have been close to getting 28,000 crores as award wins. So if you see even award win ratio, this is quite favorable, both for domestic and international put together. So it is inappropriate to conclude that whether our competitive intensity is getting diluted. I guess it's a question of the type of project and how confident and we are in terms of not compromising in margins in executing. And so we have been a little careful, but our Q1 bids to award for us has been quite, I would say, on the positive direction.
Because if I look at the recent bids in the EPC segment, so L&T is not at all aggressive. So in fact, you've been L3, L4, L5. So we don't see you bidding below for project cost most of the cases, which is quite a departure from the historical trends. So just wondering if we are connecting the two things. So thanks for the explanation. My second question.
Yeah, go ahead.
Yeah. So my second question is on the real estate segment. So 8,000 crores of GDV addition is phenomenal, and I think you're giving competition to some of the large listed developers or some of the larger developers in India. So just wanted to know whether this 8,000 is a one-off, or do we have a plan for the full year where we're looking to add 15,000 or 20,000 crores of GDV? Also, if you can touch upon what kind of pre-sales we have booked in this quarter or maybe last year. So that will give us some sense on how big this business is now getting into, because this could be a big value add to the overall SOP. So people are still not valuing this segment.
So as far as you're referring to our real estate portfolio as a developer, no?
Yeah, yes. It's a development business on the real estate side. 8,000 crores of GDV. Besides that, you have captive projects, captive land banks. So just wanted to understand this.
Parikshit, sorry to interrupt you, but your voice is not coming very clear. Can I request you to come in a better reception here and speak through the handset?
Just 1 second. Yes, I was referring. Better now?
Yes. Yes, please.
Yes, I was referring to the real estate segment. So we have added 8,000 crores of gross development value, which was announced earlier. For the whole year, I mean, this is like what the larger developers do in India. They have like targets of 15,000 or 20,000 crores of GDV addition. So if you can just highlight, is this a one-off kind of announcement, or we are looking for more such deals like this? Because this will translate to more than 2,000 crores of pre-sales annually. Just from this number, if I expect that this will get developed over the next 4-5 years. So, and also if you can touch upon what has been the pre-sales for the first quarter of this financial year, or maybe last year, how much was the pre-sales from the L&T Realty?
So, Parikshit, I will tell you that we have gone on public domain to say that as per the entire strat plan for L&T Realty is concerned, we will try to do 5 million square feet of real estate development each year. And over the next 3 to 4 years, some of these developments will be largely from our own land banks in Powai, Navi Mumbai, Bangalore and Chennai. So, and we could have, like I responded to a previous question, some joint development opportunities also that we could see in this particular area. In Q1, the pre-sales activity, we have around 649 crores of orders that we have secured in this particular segment.
Okay, but this 5 million annually, which you are looking to do sales for, will have an average realization of about like 15,000 rupees a square feet?
It depends on the property across these places. So at this juncture, it would be inappropriate for me to be so granular in terms of giving the rates, because this is a function of demand and supply. But wherever L&T projects have been launched, both in the Navi Mumbai side and also in Powai, they have definitely received a good, I think, I would say, good amount of bookings and demand.
Okay. My next question is on the monetization bit. So we have Nabha, L&T IDPL and Hyderabad Metro, 3 big items here. So do you think that in this financial year, all of this can happen, or I mean, which are the higher probability events out of these 3 which could happen potentially in this year?
So the divestment of Hyderabad Metro under the concession agreement would not be possible. The only way we can target is to bring down our stake up to 51%. And after some time to maximum, we can dilute by another 24% to bring it at 26%. Definitely, we are looking at, I would say, fast forwarding the process of divestment of IDPL and Nabha Power. Let's see. It's at the top, I would say, objective of the management. We do expect an early closure, but in terms of timelines, would be a little speculating if I had to talk about that today at this juncture.
Just the last thing, sir, you have disclosed the carrying value of NABA and L&T IDPL. Can you also tell us how much is the debt on this to
Sorry?
the debt on NABA and IDPL, if you can.
The debt on NABA is around 4,000 odd crores. Okay, and IDPL is not getting consolidated.
Okay, but when you sell it, so the enterprise value, so that was that will, anyways, it's not getting consolidated.
Correct.
Your investment is 1,100 crores.
Yeah.
And just lastly on the infra cess, sir. So infra cess has been sharply cut by the government. So government used to mop around 2.4 trillion annually from this, which will now reduce to 0.4 trillion, which was largely going towards the budgetary support in the union budget for various infrastructure investment segments. Do you think any impact of that in your ordering or awarding?
See, the union budget for FY23, I think, referred to net tax collections at the center at 19.35 lakh crores. And basis whatever Q1 numbers have come, we do expect that this number would be substantially higher than what they are budgeted for.
Okay, so you don't see any impact of this in the ordering?
At least in Q1, the numbers have been, I would say, robust enough so that we don't see any negative implications in terms of tax collections of the government is concerned for the balance 9 months.
Okay, sir. Okay. Thank you, sir, and wish you all the best.
Thank you.
Thank you. I now hand the conference over to Sri Ramakrishnan for closing comments.
So I hope all your questions have been answered. We have tried to be as granular as possible. Thanks for everyone for attending this call. It was a pleasure to interact with all of you. Thank you and good night to all. Thank you.
Thank you very much. On behalf of Larsen Toubro Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.